In this video, I'll be reviewing the latest ETF launched by Lion Global and OCBC Securities, called the Lion-OCBC Securities APAC Financials Dividend Plus ETF. Long names, yeah. This ETF lets you invest in the top 30 financial institutions in APAC across banking, insurance, and investment services. And if you are a dividend lover, you'll be super excited because this ETF pays out a quarterly dividend with a minimum of 5% dividend yield per annum for the first 2 years. But is this ETF worth investing in? That's why in this video, I'll be covering everything you need to know about investing in this ETF. What are its holdings? How is its performance? What are the fees? What are the fine prints of this ETF? And most importantly, should you be investing in this ETF? But before I start, do join my Telegram chat group to discuss or ask any questions that you might have. Alright, as mentioned earlier, this ETF holds the top 30 financial institutions in Asia Pacific. So you have names like DBS, OCBC, UOB, some South Korean holdings, Hong Kong holdings, Australian holdings, and so on. The stock weightage is being capped at 7% for each stock, which is good because you don't want the holdings to be concentrated on just the big names. As for the country breakdown, the holdings are pretty well diversified across the countries, such as Japan, Australia, Singapore, and Hong Kong, with the country weightage being capped at 20% each. And specifically, Indonesia weightage is capped at 5%. As for the sectors, 85% of the holdings are in banking, 10% in insurance, and the remaining 5% in investment services. This ETF has an expense ratio of 0.5%, which means that for every $1,000 you invest, $5 goes to feeding the fund manager every year. While this 0.5% may sound high, it is actually quite in line with all the other ETFs listed in Singapore. And in return for feeding the fund manager, the index will be rebalanced semi-annually in March and September. Now, let's check out the most exciting part. How well or how bad this ETF has performed in the past. This ETF has not launched yet, so we don't have a price chart for it. So what we can do is look at the performance for its underlying index, the IH APAC Financials Dividend Plus Index. Here, the index gave an annualized 10-year return of 6.1%, which includes dividend reinvested. Then you'll be like, 6.1% return sounds low leh. Even my ama can run faster than it lah. Okay, can. But here's the thing. This kind of return is quite normal for dividend-paying companies. In fact, the return is actually on the high side when compared to other ETFs. For example, it is higher than IHS Leaders Index Total Return, which only has a 4.81% 10 years annualized return, and higher than Straits Times Index 4.02% 10-year annualized return. Though, to be fair, the financial sector has benefited quite a lot from the rise in interest rates over the past few years. For example, if we look at the 1-year, 3-year, and 5-year annualized returns, this index has given some fantastic returns. Similarly, if we look at the all-world countries' financials, which tracks holdings from 23 developed markets and 24 emerging markets, it has given a much higher annualized returns over the past 1, 3, and 5 years. Next, as mentioned earlier, the ETF is projecting a minimum of 5% per annum dividend yield for the first 2 years. Though, 2 things to take note of here. 1. The 5% dividend yield is based on the $1 issue price during its initial offer period. Meaning, it doesn't matter whether the ETF goes up or goes down, investors will receive a minimum of 5 cents dividend per unit. Wow, so good lah! Dividends are guaranteed? Of course not lah. If you read the fine prints, they are saying that the distributions are not guaranteed and may be made out of income, capital gains, and/or capital. Or in other words, if the dividend payouts from the holdings are not enough, they'll be drawing down on their assets under management to make up for the shortfall. When that happens, you will see a dip in ETF price. But the real question is, if the dividends are not guaranteed, what kind of dividend yield can investors expect after 2 years? Looking at the historical dividend yield, the average yield is around 4.89%, with the median yield around 4.85%, which to be honest, is still pretty close to the projected 5% yield. Quick pause, did you know that Tiger Brokers lets you earn a return on your idle funds? With Tiger Wallet, you get to park your money in low-risk money market funds. As of making this video, the SGD fund is giving a 3.71% 7-day yield for SGD, and the USD fund is giving a 5.23% 7-day yield for USD. To use it, all you'll need to do is open up your app, head over to Wealth, tap on Tiger Wallet, and at the bottom, tap Manage. Make sure it says activated for both USD Cash and SGD Cash. Tiger Brokers will automatically invest your idle funds and you will start earning a daily return. You can continue trading even when your funds are in Tiger Vault. With Tiger Brokers' latest welcome promotion, when you fund your account with any amount, you will get 3 months of SGS Level 2 advanced quotes. Then, if you fund your account with 1,500 Singapore dollars within 7 days of first deposit, you will earn an extra $30 worth of Tesla fractional shares. On top of that, if you can deposit 10,000 SGD or more, keep your funds there for 30 days and complete 3 trades, you will get to participate in 6 lucky draws to win anywhere from $120 to $3,600 worth of rewards. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. Next, Lion-OCBC gave a few reasons as to why this ETF is attractive. First, financial services is among the world's most profitable sectors with a rather high 18% net margin in 2022. Second, about 55% of adults in Asia Pacific are underbanked, so there's still a huge opportunity for further growth. And in the next decade, more APAC banks are expected to join the list of top global 100 banks. Third, banks from the Asia Pacific typically pay high, stable dividends, which continue to grow over time. So this can be a good source of passive income. Fourth, this ETF also includes the insurance industry, which is an increasingly high growth industry, especially from emerging markets such as Indonesia, Thailand, and Malaysia, where the life insurance industry is expected to grow at 5% to 22% annually. Last but not least, the price-to-book ratio for the financial industry right now isn't overvalued, but fairly priced. But of course, just because it's fairly priced doesn't mean it can go up or go down, yeah. But then, if bank stocks did very well when interest rates go up, does it mean that they will jibaboo when interest rates come down? Interestingly, the answer is not what you may imagine. According to a study, it was found that while it's true that interest rates fall, the net interest margin will go down as well. However, given that banks are pivoting into other businesses, this fall in net interest margin has been offset by the rise in net non-interest income. For example, DBS also earns from investment banking, wealth management, cards, as well as transaction services. As a result, the ROA of banks has been rather stable throughout the entire period, except during the 2008 crash of course. Though, I wouldn't be surprised if bank stocks normalize down to pre-pandemic levels, given that right now, they are at an all-time high due to the boost in earnings from the high interest rates environment. But despite that, the drop, if any, may not be as big as you may think. That's because the other benefit of this ETF is that it lets you diversify across different interest rate cycles from various countries. For example, Japan banks are about to raise interest rates soon, while South Korea isn't in a hurry to cut rates, and China has already been cutting their rates to boost the economy. However, not everything is sunshine and rainbows when it comes to investing in this ETF, as this ETF comes with a few downsides. First, out of these countries, both Japan and Korea charge a 15% withholding tax on dividends. So you receive a slightly lower amount of dividend as compared to if you have just invested in Singapore banks. Though, this is already factored into the dividend yield. But perhaps the bigger issue is that among the APAC region, most of the currencies have been depreciating against the Sing dollar because the Sing dollar very strong ma. And because the ETF currently does not hedge against foreign currency exposure, investors may see their returns being impacted as the currencies continue to depreciate. Though, they also mentioned that they are open to foreign currency hedging in the future. And lastly, some people may not like the 0.5% expense ratio and be like, why not just invest in the 3 big banks in Singapore? The main reason is diversification. While the 3 Singapore banks may be the best banks to invest in right now, we do not know how long this will last. For example, 30 years ago, the largest bank in the world were from Japan, which were then displaced by the Singapore banks. So with this ETF, you will get to passively invest in both the top banks as well as smaller banks that may give higher growth. So then, who should invest in this ETF? Obviously, this ETF is for people who like to receive passive income from dividends. Secondly, this ETF is for people who not only want to invest in Singapore financial companies, but also want a quick and easy way to invest in financial stocks from other countries. Because, you know, diversification. But if you don't like the 0.5% expense ratio, foreign currency risk, as well as the 15% dividend withholding tax from Japan and Korea, then this ETF is not for you. Lastly, if you are interested in applying for this ETF before it launches, here are the places you can apply. Otherwise, once it launches, you can also buy via any brokers that have access to the Singapore markets. But what do you think? Will you be investing in this ETF? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.